before we get going, I just want to say thank you to the foundation, thank you to all of you here. The level of hospitality that we have at meetings like this is really unsurpassed here. I mean, you all really do have an impact on our time with you here. Having a home-cooked meal last night is always something we look forward to. I got my note from staff 2 weeks ago that they prayed for me and my family, which is really meaningful to me and I'm sure to others, and we really appreciate that. Really enjoyed the conversation that John had about impact. Reminded me of a similar story. I'd encourage you all to look up a woman named Henrietta Mears. She taught a Sunday school class in Southern California, and the students that she had in her class was pretty amazing as well, and reminded me a lot of John's comments in a lot of parallels, so I encourage you to do that. So with that, why don't we kick off and get started. This is the quote-unquote alternative investments panel. And the way we're going to do this to start off is just a brief introduction of yourself, the firm that you're with and what strategy you employ, and then just a couple comments on the next 12 months, what would be the ideal environment for your strategy to flourish in, and what would be a challenging one for you to flourish in.
Sure, I'll start. I'm Brandon Zick, the Chief Investment Officer of Cirrus Partners. We're a U.S. farmland manager. We've been with you guys for quite a few years. I've been at Cirrus, I was the first employee 10 years ago, so I've seen us grow from very small to now quite a large firm as we've continued to grow our portfolio and our client base. If you asked us 10 years ago, what's the worst case scenario? Well, welcome to the trade war. That's what we've got right now. We've had it for about a year and a half. We spoke about it last year. In U.S. agriculture, like a lot of other industries, we're a big export-driven market, so we don't like it when buyers are removed from that market. That being said, in the face of what we would have considered our worst-case scenario with a strong dollar and a trade war, we've still been able to produce positive returns every year, and we're actually really excited about how it might get resolved. So over the next, call it 10 to 12 months, I don't think it's going to happen right away, but the tailwind that we'd be looking for is some type of resolution to that conflict and more U.S. exports going to China as well as everywhere else.
Hi, I'm Stephanie Batchelor with International Farming. We are also one of your farmland managers. Since we were here last year, we have launched a new fund with around $400 million of new capital to continue the strategy which you all hold in the Fund 2 portfolio, which is buying large, diversified farmland here in the U.S. We focus on crop diversification, and Brandon said it well. It's been a very tough market with the trade war with China and the compression you've seen on a lot of the Midwest commodity crops. Where we have really tried to focus in your Fund 2 portfolio is diversification. So you've got not only those staple U.S. commodity crops, but also export-friendly crops such as citrus, small plots of almonds, vegetables, cherries, some produce, and then your larger development properties out in California and Arizona. A tailwind we get very excited about is the new food economy, and the two things driving that are food security and consumer preferences. And where we get excited is how consumers are buying and making choices in the grocery stores are impacting the type of crops we're growing on our farms. And we get really excited about that. Thank you.
Hi, everybody. My name is Mark Wallace, and I'm with Resource Management Service, LLC, where I'm the timber guy. And I'm the U.S. portfolio manager responsible for about 2.2 million acres, about $4.1 billion in assets. And we're concentrated in the U.S. South. And I think in terms of tailwinds for next year, I'd be very excited to see an uptick in housing starts, the thing that we've been waiting for quite some time since the initial crash in 2008. And that'll have a lot of ripple effects, both in our industry and others.
Hi, I'm Richard Patton. We manage two portfolios for you all. One is a distressed securities portfolio. I think that the tailwind there is we can see that there are a lot of companies that are going to need to go through restructuring right now. As a matter of fact, there are probably 30 to 40% more companies that have been taken private by private equity and are considerably over leveraged than there are companies in the publicly traded markets today. And so there are lots and lots of companies there. There are lots of them that need to be restructured. And I think that the best thing that could happen this year would be that their prices reflect the reality. And they've been kind of consistently being able to extend their capital structures temporarily as rates have come down. And so I guess we can go negative because rates in the United States can go negative because they have, in the rest of the world. But if they don't, we should see a considerable pickup in activity in our distressed funds this year. The other thing we do for you all is we run a music royalty fund. And I'm going to talk about that a little bit more later. So I think kind of everything, it is enjoying a substantial tailwind that we'll discuss later.
My name is Bob DeRoshi. I work with First Trust, and we manage your preferred strategy. And I think the tailwind is just if the Fed continues to keep rates low, we're going to benefit. And certainly we've had a great year this year in our strategies for you all. Certainly the headwind is if we see a rate shock and rates all of a sudden decide to go significantly higher, that could put pressure in our space. But right now, we don't see that event happening. So right now, we're enjoying the fruits of our labor. So I'll stop there.
So maybe just a follow-up on that before we get to the next main question for you, Bob, is you said the ideal strategy is that the Fed keeps rates low. At what point will the Fed no longer be able to control? It seems like they have shot almost every bullet they have left. At what point does the market dictate the rate movements versus the Fed?
It's interesting. Richard said it, hey, we could have negative rates here in the U.S., and we just don't see that event happening. Certainly the Fed does not want rates to go to negative yields. It's just not a good thing in long-term programs. I mean, think about this. If the 10-year went to -3, let's say that happened. That means if you held that bond for 10 years, you are guaranteed to lose 30% of your money. And I just don't see investors willing to accept that amount of return negative for a risk-free rate that investors typically are getting a yield of 2.
A risk-free loss.
Yeah, it would be a risk-free loss at that point. Yeah, you're guaranteed to lose 30% of your money. So to me, I think the Fed is going to be conscious of that, and they're going to keep it at around inflation, which is right now at about 1.8. That's what the 10-year is right now. So that's sort of where we see things panning out here.
Interesting. I'm sure we'll talk a lot more about rates with the fixed income portion, but it's certainly an interesting environment that's not in any textbook that I've seen. So maybe just the first sort of general question for the panel, we're up here as an alternative investment panel. By definition, alternative investments have to be different than mainstream. Mainstream is constantly evolving and changing. So what does that mean for the future of alternative investing? What types of things? I mean, I think 15, 20 years ago, maybe we saw drug royalties, Richard, but maybe not music royalty funds. We're seeing crypto funds now, cannabis funds, all of these different evolutions of quote-unquote alternative investing. What is it going to continue to evolve to and look to? Not necessarily, if you don't want to comment on the overall industry, but maybe in your specific industry, with farming, how is it going to evolve to look at solar or wind or other uses for those lands? Maybe if anybody has a comment on that specific to their strategy or at the macro level of the industry.
I might add something quickly, at least on the solar and alternative land uses. One of our small pieces of our revenue streams are from a lot of new solar leases or options to potentially do a solar development project, and the multiple on price per acre is quite high on those. And we also embrace the land use and what that means for the future of our economy. And so solar is one of the things we've looked at, but it's not I'd say, a material part of the revenue stream, at least not now.
I think alternatives, it's obviously a huge bucket. It can include, it's rare to have two farmland managers in the same panel, but because there aren't that many of us, but it can include so many different things. Farmland really fits into what we'd consider a real asset bucket. So it's tangible. It's something that it's not going to walk away every day. I mean, we really own dirt. And what you're investing in this asset class is really, you want something that's diversified and non-correlated with the rest of the markets. And it's because things like rates and earnings for companies don't drive farmland value. It's really farm profitability. In this real asset bucket, you're looking for something that generates a lot of income, which row crop farmland tends to do. And that helps really mute some of the volatility you'd see in returns over time. You also don't have a lot of institutional investment in here. I think it's going to change over time, but you don't have big swings in value because the Fed did something today. It doesn't price that quickly. So I think from an alternative standpoint, that bucket's going to continue to grow. It seems like even on the equity side, index funds have grown so much, and then you have other managers that are just closet indexers along the way, that over time, anyone in the equity market who's active may be considered alternative, the way things seem to be going.
I think alternatives mean either how you're exposed to something or that you are exposed to something. And so 30 years ago, I think, we really never talked about REITs. You know, real estate was owned by either large insurance companies or pensions or individuals. And then slowly but surely it became a securitized asset class, and everyone was able to own a piece of a big business, you know, or a big building. And so people who owned real estate in the early 90s in like a private REIT or something like that were considered to be alternative managers. And that's kind of the way it is for farms today. But over time, those things will probably migrate themselves into public market assets, and they will be securitized. And then the other side of alternatives is how you own something. You know, am I long one asset and short a similar asset so I can isolate something particular about the one I'm long and get rid of risks I don't want in those things that are short, that I am short. And so, just a thought here.
I was just going to briefly say, in the Fund 2 structure that you all learned, one of the things we've noticed is a lot of the crop cycles move in longer stages than we originally thought. So where you have currently some systemic pricing with corn and soybeans and those commodity crops, what we've realized is, you know, we're here on the alternative panel because your holding is somewhat illiquid. And we've transitioned, or are transitioning on our leased farmland strategy to...
Bring up your mic.
Sorry, is that better? We've noticed with longer term commodity cycles, in moving from a more illiquid structure, a closed-end structure like you have currently, there could be benefits to a more open-end REIT type structure, which is where we are moving to hold a lot of our long-term leased farmland. It gets the benefits of aggregating for scale, for committing to long-term partnerships with our growers and our food buyers, and then that's, you know, that's one of the benefits, I think, to thinking longer term, while also offering liquidity versus a more typical closed-in alternative structure.
You know, one of the things I wanted to add is, you know, you think about alternatives, like Richard said 30 years ago, the average investor, you didn't get access to those areas. And now there's solutions that are coming out, like at our firm at First Trust. We have thematic exchange-traded funds in alternative areas. And that's the exciting part about looking forward, that the average investor, you're going to have access to these types of opportunities. And that's what we're excited about, because we're bringing those types of strategies to the marketplace.
I think one of the things that I hear from that, Mark, did you want to make a comment on that?
Just real quick, because I think timberland is in the intermediate space between commercial real estate and farmland, where we do have timber REITs, and we're seeing some of that evolution in timberland. And in terms of the how you own, that's what I think RMS in particular does well, which is we're a vertically integrated manager. I work hand in hand with foresters from Texas to North Carolina to make sure that we're excellent stewards of the forest, good fiduciaries, and I think the alpha that we start to bring comes from that, comes from longstanding mill relationships, and also from, if you do still stay as a private investor, some of that alpha will come from working with a company like ours and maybe doing additional principal investments either through us or alongside us to not only own the forest, but maybe even invest in some of the productive capacity to improve the local economy.
Great. So one of the things I hear in that is that vehicles have allowed access to different stores of value that were previously, maybe harder to get to. And one of the things I'm starting to hear more and more about with, people talking about negative rates, people getting concerned about currencies, et cetera, they're looking at other places for stores of value that would be decoupled from the more liquid, highly traded, typical stocks and bonds. So if you all had to look at a store of value that isn't your own asset class, what would you look towards as be potentially a safer or less correlated store of value if we do have, sort of crises or a decoupling?
Vintage Ferraris.
Those are liquid.
I'm serious. As the money printing has run amok, that's probably the best performing asset class. And so, all kidding aside, the more scarce something it is, the less replicable it is, the more value in terms of the commodity, the currency produced it will become. So, kind of anything or any business that you can contemplate that is very, very difficult to imitate, or it's often described as having a moat around it. If you believe that the Federal Reserves writ large or the central banks writ large are going to continue to do what they've done for the past 10 years or 20 years, and I don't know why they wouldn't, then you should own as much scarcity as you can get your hands on.
So other than vintage Ferraris, what else do you see as scarce that you would put a store of value in?
I really, as soon as I say it, it's going to get cut in half, so I just
It's good, we'll short it.
yeah, exactly. Just broadly speaking, if you go, just look for companies that are very, very difficult to replicate. So there's a reason, Facebook, Google, Microsoft are, such large components of the indexes. Companies like that are very, very hard to replicate. I'm probably going to get, annihilated for saying this, but sooner or later, gold will fulfill its promise because it's nothing more than a currency, and it's a currency that can only be quote unquote printed at 3% a year versus the other currencies that are being printed at 5, 6, 10% a year over a long period of time. It, in exchange for currencies, will be more valuable.
Guns are going to become scarce at some point. How about that one?
Yeah, I actually think one of the interesting things that's going to happen is, Richard said it, it depends on how you own some of these assets long term. So what may have been an alternative before, like commercial real estate or private real estate, as soon as it's equitized and people can trade it every day, if you take another scarce asset and turn it into an ETF, a lot of that diversification and non-correlation that people like, and one of the reasons those asset classes perform well on a risk-return basis, all that disappears when someone can trade it every day. Even though the underlying asset may be performing well, if the stock market's going down and you can trade it like an equity, it's going to look like an equity. And that's something that we think is, it's going to be really interesting to see how it pans out. In terms of store of value, we're really thinking about how to invest in something that is probably the most important asset, and it's water. Water gets used and wasted all across the world every day. Our belief is long-term, most societies that have been successful have found a way to harness water, whether it's for irrigation, for flood protection, or even sanitation. And those societies that have failed over time have lost their grip on that. So, in farmland there is some kind of loose correlation with water, but we don't think trading water rights and doing water transfers is the way to do it. Owning the resource as opposed to the right is probably more important long term. And in the U.S., we've been blessed for a long time with plentiful water, but as it becomes more scarce and more expensive, the tide's going to go out, and it's going to be interesting to see how that plays out.
I totally agree, because I was thinking the same thing, water. Because 23% of the world's water is here in the United States, in the Great Lakes. And that is a precious commodity that other countries cannot replicate. And with climate change starting to happen, it's going to become more commoditized. We actually have a water fund that we brought, FIW, for that reason in our strategies. And it's done very well. But it's more the infrastructure of getting access to the water as well. Because remember, you got the water there, but you might have to bring it to the deserts or to the climates that need it. So that infrastructure is an area that is also part of that process.
Yeah, and some of it will be technology, whether it's desalination or other things to create more water. It's not a resource that can't, fresh water is what we're talking about, not just water, but fresh water. There are ways to create it. The increase in natural gas resources in the U.S., the price decline of that makes a lot of that more realistic over time. You can go to Israel and see they're the world leaders in water technology because they don't have it. So if they want to survive, they have to create it. But there's not an unlimited resource, and that's where we think longer term, everyone on this stage at some point is going to either be investing in water or figuring out how to take advantage of what they already have.
Great. So maybe a good lead-in, especially for the three managers to my right, talk a little bit about how weather and or climate change, we'll leave off whether it's influenced by man's actions or not, but it certainly seemingly is real. Talk about how weather and climate change is potentially affecting your strategy already, or how it will into the future.
So yeah, in farmland, Mother Nature is a big component of being successful. Our strategy has been, if you own the core asset in the best region with the best soils, the best access to water in the form of either natural rainfall or recharging plentiful aquifers, so those Great Lakes that Bob referred to, when you look at our map, we're all around it because water's free, it's plentiful, and we think over time any change in climate, whatever that may be, global warming, more weather volatility, when you own the core asset, it is the safe haven. It's the store of value. And in other areas where water's more expensive, where right now you can grow some of those crops that people love to talk about in the Central Valley of California, in other water scarce regions, we think that's a lot more risk. And over time, risk-adjusted returns are going to reflect that.
We say a lot at International Farming, if you buy a good farm and take care of it, you only buy it once. If you buy a bad farm, you'll pay for it over and over. So we put a lot of due diligence and resources towards not only how do we buy farms, does it have good soil, does it have good water, but also how do we take care of those farms for future generations, and to how do we leave the land and the soil better than we found it. Where we look to is our agronomy and our technology platform. We use soil samples and testing. We test all of our farms on an annual basis. We make sure that our growers are not putting too much nitrogen in the soil, which creates runoff, which hurts our rivers and our estuaries. And then we're building in-house a technology platform that helps us monitor water usage. You own a farm in your Fund 2 portfolio out in Arizona that comes with very senior water rights on the Colorado River. And there's a lot of regulatory talk these days about how to protect water, who owns the water. And so a lot of that is part of the due diligence process when buying and taking care of your assets over the long term. You can't have a good farm without good water, and that's been paramount at IFC.
So I'll say a quick thing about water and then get back to the climate volatility question. I'm happy to say that stewardship of forests is a key way to maintain a healthy watershed, and that's something that we haven't really, or forest owners in general haven't really been compensated for, but it's something that we're always on the lookout for opportunities to support the ongoing stewardship of forests, best management practices, and on all these other values that they provide, but that investors, owners, society in general aren't being compensated for maintaining those forests. But then on the climate volatility, that's one of the things that keeps me awake at night. The timberland assets are subject to a number of disturbance events, and those have increased. Luckily, we're not subject to a lot of the wildfires in California because our forests just they're not subject to the same risks, not the same kind of fuel load, different management. But certainly hurricanes, the foundation's portfolio was impacted by a hurricane just a day after I just talked about it last year, and I've been working to get insurance recovery on that. But volatility can come in a number of ways. Winters that are not as cold means that there are more bugs. There's other pathogens that could potentially impact forests and cause sudden spikes in either supply or render formerly valuable trees as pulpwood, so a lot less valuable. And those are things that we are on the lookout for. And one of the unfortunate consequences of wildfires and hurricanes just last year is that it's been much harder to get any kind of insurance. And many timber investors self-insure, but the insurance market has changed radically in just the last year, and that worries me.
So I'm going to have a few more minutes of questions and then open it up for anybody that might have questions in the audience. So please feel free to start thinking of any questions you might want to follow up on any of these conversations. But the next panel we're going to talk a lot about valuations, both in fixed income and equities, where certainly it's pretty obvious that things are richly valued. But I think one of the challenges, I've been in this business for 25 years, and it seemed like there was always a few things that were obviously cheap. Now, they came with an obvious risk of why they were cheap, perhaps, but it was, there was times where emerging markets looked really cheap, or high yield looked really cheap, or some other asset class looked cheap. As I look around today, there's very few things that look cheap. And as a value investor, which more than half the investors seem to say they are, I would think that'd be an extreme challenge. So as you look around, what do you see out there that could be cheap, that you think maybe other people are missing or they're not paying attention to, and you would see as a good point of entry?
Well, I'll start. I mean, when I look at January 1st of this year in the bond market, preferreds were cheap. I mean, they were trading at 95 cents on the dollar. And we've had a big rally this year in the preferred market. Now they're trading at 105 on average. So, you look at the performance of our fund, we're up 15.5%. And we're preferreds. It's been a great year for us and for your foundation. But the challenge is it getting overvalued? And the way I would describe that is, yes, on a price point, we're at not all-time highs, but we're getting higher. But when you look at it from a different metric, and that's a yield component, yields are so low, where can you replace that income that we're generating on this strategy? And our yield right now is 5.7%. So that's an attractive income stream that you're getting, but you are paying a higher valuation because of what we had this need for yield this year around the world, especially with negative yields in Europe and all that. So that's sort of my take right now, is just on the preferred specifically.
I'm going to talk about it later.
Okay, great.
I'll say it's, at least just thinking only about the timberland space, it's hard. It's very property specific, much like location in real estate. It's very property and local market specific. And I think that'd be my answer. You have to be very, very diligent about underwriting any new deal. And one thing that I have seen, for what it's worth, is that you talk to any timberland manager, anyone in the space, appraisers, everyone will say, well, we're we're buying deals at 5 to 5.5% real, and they've been saying that for quite some time. Meanwhile, interest rates have continued to fall, and I think a lot of other people who are underwriting at this time are maybe pushing other assumptions so that they can still say they're underwriting at a certain level, and that's something I'm very careful to make sure we don't do.
At least for us here at IFC, we've seen it's been a relatively low inflationary environment, which has not been super supportive on the appreciation side for farmland the past few years. When you combine that with where you've had some very aggressive commodity pricing pressures since 2013, some of those have been down 30 to 50%. My family, we're corn and soybean farmers from eastern North Carolina, so we're not only am I working in the environment, but we're managing a farm in that environment as well. On the institutional side, we've had a lot of interest. It could be a good buying opportunity for folks who have thought that U.S. farmland may be overpriced. They are seeing it as an entry point opportunity, and it doesn't at all change our due diligence or investment theses and objectives with how and what type of diversified portfolios we put together. But there has been quite a bit of institutional interest in the farmland market, given the activity.
Richard, you wanna?
Yeah, this isn't in our book, so it's and so I think finding things that are cheap. I think I'm going to talk about something that I believe is absolutely cheap later, but everything else is relative. And I think on a relative basis, for those of us who live on the east of the Mississippi River, I think Texas, Tennessee, and Florida are cheap relative to New York, New Jersey, Connecticut, Illinois. And you just see you all have been to Nashville. I imagine a lot of you have. I go to grocery stores now, and I only recognize 10% of the people, where I used to know 100 of them. And just what's happened with the tax code changes and just the relative cost of living is forcing, on the margin, really wealthy people to live the states I mentioned secondarily into these more hospitable environments, and I don't see that trend slowing. And on a relative basis, you can live in Connecticut, and you can sell your house down 30% from where you bought it and buy a new one in Nashville and make an additional $100,000 a year. And you can do the same thing in Texas, and you can do the same thing in Florida. And I don't see, please.
I live in Connecticut. He's absolutely right. My house is down 30% in 9 years. There's 7 homes for sale on my street, and not one is sold in 2 years. And I'm looking to move to Nashville. I'm serious. Nashville is on the list.
Yeah. And we have bumper stickers that say, "Remember why you moved." Don't bring your voting record with you.
Yeah,
I'm very conservative. I'm not one of those. I'm right of Attila. So you don't have to worry about at least me and my wife.
But you do have to be careful. I mean, Connecticut, it wasn't that long ago, they had zero income tax too.
1986.
And those things change. You bring the right type of people into these areas, and politically they can change that over time. I mean, it happens even in states that don't have zero state income tax, but if you're a state surrounding Illinois, you have a competitive advantage because people don't want to be in Illinois because it's a state going bankrupt with really an unending torrent in that direction. So if you're Indiana, Wisconsin, Missouri, Iowa, you have a competitive advantage, and we see it just, I mean, if you buy a farm and now it's in a housing development area, that's a freebie that comes along, but I think, that's not going to change anytime soon. It's only going to get worse.
Great. Well, on that positive note, for those of us that live in the South anyway, let me open it up for questions. We've got about 4 or 5 minutes left, and if any of you have any questions that you want to ask, got one question in the back.
Yeah. I saw a blog on television, I'll go ahead and keep it, where Trump was announcing that he got a concession from China that they would buy an additional $50 billion worth of agricultural products. And the response I heard was that the farmers couldn't fill that demand. And possible that the farm communities, agricultural communities cannot meet that demand? And if so, what does it mean for farmland and timber? Will timberland, will people in timberland take their land out of timber and put it into agriculture to try to meet a demand? They say they can't do that.
I'll say as a farmland owner, this would be the best problem to have. That $50 billion number is fantasy. I mean, China is not the largest agricultural trading partner with the U.S. They really only buy four crops in large scale. It's pork, soybeans, cotton, and almonds is the other. Each one of those crops has taken a big bath in the last few years because of the trade war. But those crops aren't going anywhere. If you own an almond tree, it's going to produce for 20 years, and you have to sell them to somebody. If you grow cotton, you're going to grow cotton or soybeans. And I think what we've seen is there's been a lot of friction involved in the trade market. So something that easily would have gone to China before now is going to Europe. So a non-GMO soybean, there's a big market in Europe for that. And you'll see China's being supplied by Brazil. There's something going on in China that's actually going to change things quite a bit. It's called African swine flu, which China's the largest consumer of pork in the world. They're the largest grower of pork. They import all these soybeans to feed those hogs that are in China. They don't grow all the soybeans themselves because they don't have the water to do it. But they've just killed off over 50% of their hog herd. So we now in the U.S. have record hog prices. And hog producers in the U.S. are building more barns because they're not going to export soybeans. They're going to go higher up the value chain. So the way to get to that $50 billion is instead of sending over soybeans at $9 or $10 a bushel, you're sending over hog carcasses at a much higher value, which actually creates more internal demand for those soybean crops. So we actually think it's going to work itself out quite a bit. There's a lot of noise out there about what's actually happening, and the reality is it couldn't really be farther from the truth at some point, but no one has let the truth get in the way of a good story, and I don't think that's going to change.
Just want to note this is the first investment meeting I've ever been at in 25 years where I've heard the word carcass. So thank
Won't be
you
the
for that.
last.
It won't be the last. Any other questions? Yes.
This is a question for Mark. The timber market in the south, of course, is the pine tree. Is there alternative trees that have any future? For example, the empress tree, the monument tree, is that a sham? Is there a potential there?
Is that the high carbon sequestering tree? Yeah. So the question is, our primary species here in the U.S. South is loblolly pine, and the question was whether there are any other species, one in particular that's being known as a very high carbon sequestering tree, and I would say the answer is no, just because the primary end markets for large logs is lumber, so housing for new starts, repair and remodel, potentially also tall mass timber buildings. On the high end of the product spectrum of those trees, and then on the lower end, it's pulpwood. We're largely exposed to paper and packaging, and I'll say this: we'll grow anything if someone pays us and pays you guys to do it. And if we do get a price on carbon, depending on what that price is, we'll look at any kind of silviculture or crop arrangement that we think makes sense. Hope that answers the question.
Maybe time for one last question if anybody has one. Ross.
Who's going to win the election?
Considering the joint panel was 0 for 16 or whatever it was last election, we'll put an asterisk next to that, but who do you think is going to win the next election?
Trump.
Trump. Anybody want to disagree?
I liked your idea last night that he'll probably be taken out of office and reelected.
There was a conversation last night that would definitely be a first. Okay, well, I'll turn it back over to John. Really appreciate everybody participating, and best of luck to everybody. Oh, yeah, Bob, one last question. What did you give up this year?
So this year I gave up pretzels. And the reason I gave up pretzels is I do 150 flights a year on Delta, and I ate all those little bags. So I get on the first flight January 3rd. I'm like, all right, great. Give me the baskets, no pretzels. They switched to Cheez-Its. And now I'm eating Cheez-Its.
All right, well, we know it's coming next year. Yeah.
No.
All right,
All right, on that note, if y'all will help me and say thank you to these guys for being with us.